afternoon, everyone. My name is Russ, and I welcome you all to our emergency update here on DataDash. Guys and gals, today is Wednesday, and the CPI print has just been released. And for those reasons, before the stock market is going to close, I wanted to give you an emergency update. Despite the fact that Nick already has provided today an update regarding the altcoin market and his views, I thought on top of everything, we are in such a roaring kitty GameStop AMC mania, and I'm hearing my friends reaching out to me, to other traders, telling me, Russ, oh my god, how much should I put into the GameStop? How much should I put into the meme coins? And I personally feel very bad about it because mostly the people gonna lose money. Despite the fact that I just quickly made 30k yesterday, here's a screenshot down below. I want to give you way better plays than GME and AMC, but they all gonna be from the stock market world. So those gonna be the real companies with the current revenues and existing business model. With all that said, let's go. So today we're gonna go through, first of all, the weeks. Second of all, the macro update. Then we're gonna see what happened to the traders that entered AMC and GME yesterday. They're mostly 60% down from yesterday top when those stocks start to be appearing in the news and in the journal magazine updates, right? That's where I gonna propose you a way better set of the stocks that are currently having an extremely high shorted outstanding float, but nevertheless they're very close to their lows, so your invalidation points are going to be extremely tight, and the upside potential, in case you would like to play a little bit of a lottery, is going to be much better. So with all that said, we start here. First of all, guys, before we even go into any particular stock, super important update on macro. Let's not forget, yesterday was the PPI print. It came hotter than expected. Market got quite scared. And all the expectation, especially the world of crypto, I outlined in our private Telegram group for the DataDash newsletter subscribers. Here's the screenshot. I'm waiting for 64 and 65k on Bitcoin, and I wrote it down yesterday, and that's here we are right now. So what actually happened? First of all, Powell came yesterday and he said that his confidence is not as high about the inflation moving down to the target levels of 2 or even 3%. He still expects it to decline, but he's way less certain than before. So based on that, I would not anticipate the core CPI dropping flow from last month's 0.4. The market expect 0.3, and this is how we ended up today. Nevertheless, if you remember, my last Friday update was done with me sailing with the crazy waves. I found a little safe spot and wanted to give you those updates, basically re-uploading it with my personal hotspot with a mobile phone. I am still expecting the huge market correction. That CPI print today that just came in line with an expectation would provide nothing more than the short squeeze for people shorting the bottom on the Bitcoin and altcoin range. Those late shorters have to be obliterated, but it doesn't mean that because the CPI print came low, we're gonna just go up only from here. Not at all. First of all, what I'm thinking is that the Fed needs multiple rate hikes. Maybe 5, maybe 6, maybe 7. It is incredibly ridiculous to speak about the cuts right now. And I expect the hints of those hikes to start stepping in Q3 with actual real hikes starting in 2025, and that will impact the markets. Only thing that Fed is trying to do is to push that problem further. Then the election would happen in the US. So they just don't want to deal with those until November this year. And that's why they're trying to be very wishy-washy with all the languages they use. But let's look at the real numbers. First of all, the Fed claims to be restrictive, and I completely disagree with that. With a GDP of 3% and inflation of 3%, which is a total of 6%, the Fed fund is at 5%. This is not restrictive. This is opposite to that. And additionally, the Fed plans to reduce the quantitative tightening, which reduces demand for long-term bonds and manipulates rates lower. And this further fuels the inflation even further up. I don't think the Fed is restrictive. The reduction of quantitative tightening is propelling inflation even further. And the current high readings and data suggest that today's CPI, which came in line, is just a fine-tuned methodology. I would not say it's fake, but guys, here is the article from Forbes that says if we would measure the inflation with the same standard as we had several years ago, that we're probably gonna be close to 20%. And this is also something that most of you feel when you go to the supermarket and you do your groceries. Of course, it's not 3%. So yeah, let's be also humble about that number. Moreover, the economical data is unpredictable, and I believe my perspective is valid against the market and Fed's more relaxed stance. Unless we see a miraculous 0.2 today, which is not the case, the Fed approach is misguided. If inflation is not contained, it risks spreading and increasing further, and Federal Reserve here is not in a safe position. It is okay to have a different opinion from the Fed, and I sometimes do when things seem off. So let's honestly see how it unfolds. But then, regarding the market, it is still looking strong. The CPI number is good, and Nasdaq and S&P, and moreover Russell 2000 reacted accordingly. What I like to see, in case the CPI would come bad, my first thing to look at would be how much the Nasdaq would correct. If Nasdaq corrects 1%, that means bad news, good reaction, and that's bullish. If Nasdaq drops 3%, then I would be very cautious for more downside risk to follow through. I'm giving you my outlook of how I'm gonna look at the next CPI print, because for me, the fact, as I mentioned already, that this CPI is good doesn't mean much. We're gonna look for the next one. And moreover, it's crucial to measure market reaction to news rather than letting biases lead us astray. This market currently wants to go up. Fine, let market go up. To illustrate further that market is in a tricky position, let's have a look on the put-call ratio. Put is an option that people purchase when they are expecting the price to go down, and the call is an option when you normally expect an upside, and that is normally signalizing the bullish behavior. So when put to call ratio is the lowest, and this, guys, honestly the lowest we had in years, at 0.389 if you only take equities, no indexes. This is the number we haven't seen since 2021, and when we had a similar numbers in 2021, that was actually the beginning of a correction. Let's have a look there. So the orange line is S&P 500, and what do we see when people are getting too bullish on the market? Bam, correction. With that green week, another green week and correction here, another green weeks and correction here, green weeks, correction, green weeks here, further correction, and so on. Well, this chart doesn't look like it's a huge correction, but trust me, if we're just gonna take a measure and we see, oh, it's a 13% correction in S&P 500, that's quite a lot. And why those things are happening? Well, because both puts and calls are options, and options have an expiration date. There is a certain term which is called the max pain. So at which price both put and call owners would have their option expiring at the lowest value possible. Why it is important? Well, because the market maker sells those puts to institutions and to retail. And once the market maker is selling something at a cost that later on expires worthless, so he can buy back at zero, the market maker is profitable. So that target or the goal of the market maker, of course on top of providing the liquidity, is to make sure that when one side of the market is acting a little bit irrational, jumping out of their pants, thinking up only, then wait a second, let's bring the market down and let's make those calls. Don't forget, put-call ratio is at the lowest, meaning there are many calls, meaning market is beating on the bullish outcome, so bam, let's wait for a little bit, let's make those calls expire worthless, so that market maker is not at a loss. What I'm doing in this case, I am buying the week's calls. So weeks is the volatility index that is normally emphasizing the tendency across the market. Weeks is having a complex formula for its calculation, but it's normally also representing the number of puts and calls in the system. Lower weeks, meaning too many calls. And weeks is the type of a product for which you can buy option itself. So I have that red bar here, and what I do every time that wicks goes down to that zone of 12 to 13, I am buying calls. Bam, and wicks tends to bounce. Does it have to happen? Obligatory? No. But if I don't want to sell my stocks, which are those value plays in a great profit, like Piedmont Lithium, like Apple, like many more. What I'm doing, I am buying the week's call itself. In this case, for me, the good call would be those ones with an expiration end of May or beginning of June because they're very cheap and the strike price is around $14, $15, $16. That's what I'm personally doing. Now, when it comes to the YOLO plays, first of all, there are at least 20,000 tokens being launched daily on Solana, and obviously most of them would never make it even beyond the name. There is nothing behind, no business model, no customers, no potential vendors or anyone who would like to work with the project, absolutely nothing. But the difference is when you go to the New York Stock Exchange and the company is listed there, the barrier of entry is so much higher, is incomparably higher. And if you want to look for the short squeeze, this video is for you. First of all, are we gonna enter in GME and AMC? Unless you know how to play calendar spreads, no way. But that's quite complex, and for those reasons I made an analysis today giving you other candidates which are way better in my opinion when it comes to the potential short squeeze. First of all, let's have a look on a company called SPWR, the SunPower Corporation. Why it is so striking to me? Well, because the short interest for this company is 82%. Now, looking at the chart of this company, what do I see? Well, first of all, I see the market structure break. The first time we have printed the higher high since forever, since years, since the company stock was at $30 plus, 30 at these levels, and now we are at 3. So yeah, does it look like it can bounce from here? Definitely, but I am not looking forward to buy here at $3.10. However, I'm gonna be closely watching this stock. First of all, because the short squeeze potential to run higher, it is relatively high. It is the first time that we start to properly trade between this 50-day and 200-day moving average, and I would be looking at adding into my position somewhere here once we are back to that zone between $2 and $2.90. I would consider the entry DCA. Obviously I don't want to enter the market at any given day. Several entries in this zone and the stop loss acceptance on the daily below the previous low of $1.70. Now let's look further. The second candidate for the short squeeze in my opinion is the Lucid Group. Of course the company is not net income positive. I would love to emphasize that most of the plays I'm going to bring today is purely speculative, but I would prefer you to play that speculation with the Titan validation for the existing business with very much sustainable yet not profitable business model, rather than playing some random meme coin on Solana that is actually backed by absolutely nothing. So here we see 30% short interest as a percentage of the float. And in my opinion, if we're gonna go now to the chart, we're gonna see quite an interesting scenario. First of all, we are having a high probability for printing that higher high first time in the market structure break. The OBV, the on balance volume, is rising positive. The stock is accepting above its 50-day moving average first time in years. Again. Let me zoom out and see at which values the Lucid has been trading during the era of low interest rates. Well, we are speaking here about 2 digits. I can zoom back. Oh, wow, where we are in the EV mania. $50, $60, $70 per stock, and right now we are so much lower, obviously, because as I explained in multiple streams, there is a reason why those growth stocks are behaving so poor in the high interest rate environment, because they use a huge leverage, and obviously the burden, the cost of this leverage is increasing exponentially with the interest rates going that much higher because the companies are not profitable, they have no margin of safety. But I love the volume and I see this green outstanding volume on the breakout and the correction of today, this red candle to cover the gap outside hours is having such a small volume. What I love to see is when we have the positive increasing volume on the positive increasing price action, and then with the price correction the sellers are not stepping in to sell, they are expecting the price to make more moves up. So good candidate for me to start scaling in here, have something like that from the 50-day moving average. I would like to enter, and my stop loss could be slightly below this previous lows, $2.50. My take profit is at least the previous highs, which is $4, or maybe the second take profit is 200-day moving average, or that, or the block here, that red candle that actually caused the market structure break further on and creating that low. So where else I'm looking at? My third pick of today is GoPro. Obviously everyone knows this company. The revenues are not the best. I don't see any CAGR or ongoing growth. They're quite flimsy. Net income not the best. However, let's see, 5% off. Short interest, and when I'm going to the charts, I think that this entry cannot be better. Well, we are speaking about $13 all the way down to $1.70, and obviously I'm not recommending you to enter the entire position just yet. Despite the chart looks like the company is going to go bankrupt, it is quite probable that someone would actually acquire it, so I would personally enter a small position. Good risk reward for me. Again, the risk reward comparing to playing AMC, GME, or any of the meme coins. I'm not comparing that with owning the blue chip stocks. Please don't confuse that play with buying Russell 2000, for instance. But when I'm seeing the charts like that, I might consider playing a little risk. GoPro will be my third bet, and my fourth bet would actually be Zonder Holdings. The Zonder Holdings have a very interesting story, and the story is following. The special thing with Zonder Holding here is that it has the huge number of days to cover. What does it mean, the days to cover? Well, just until now, we looked at the percentage of number of shares which are short. And obviously, it's a great indicator. Here, what is really outstanding is the average daily trading volume is very low. And it means for the short seller to be able to cover his short interest, he would need to buy those shares from the market. So the days to cover actually show the ratio between how many millions of shares are shorted comparing to the volume, to the trading volume, the daily trading volume, and it gives us the number of days to cover. In case of Zonder right now, we are at 23. So if we're gonna start the squeeze, it's actually gonna take extremely hard moments for the short seller to get back and cover his position. So that can create a huge discrepancy. And on top of all, the implied volatility on Zonder is above 150%. It means that the options are very expensive. If the buyers are not just gonna buy the shares, but they also gonna sell, for example, the puts, then that would create on top of that the gamma squeeze, because the market maker, in order to make his position delta neutral, would need to buy the stock himself in order to hedge the long put position, which he's forced to take when you are, as a retail guy, is selling the put. So maybe it sounds a little bit more complicated, but Zonder, trust me, in my opinion, can have a great momentum here. And let's look at the chart for now. It is also the reason why I like the stock, because the invalidation point is very, very close. So the chart is not looking like AMC and GME by far. if you look at a daily right now, we are at $3.72, and we are kind of consolidating in that meme line triangle. So in my opinion, getting anywhere close to here is the very tight invalidation below the previous low can bring us all the way to 750 or the next liquidity target of $9.70, which is an amazing risk reward of 8 or above. And last but not least is the company called Car Parts. What I love about it is that lower we go, more apes are jumping to short that stock. And if you guys have been watching my streams for several weeks by now, you know what does that mean. The market always punishes the late entrants. And if there are a bunch of shorters that are shorting towards the divergences, towards the support, there is of course a certain intrinsic value at which this company is traded. Once again, it's not a meme coin, it's the company with roughly, let me have a look, with a roughly $160 million of quarterly revenues, and it's operating very close to break even regarding its net income. So yes, there is a certain market cap, and this market cap is $16 million. This is very small, of course, for the business listed on New York Stock Exchange. And let's have a look on the chart. In my opinion, the entry here is also providing us a very tiny, very close by invalidation point, a very huge risk to reward ratio. And once again, I really want to emphasize that please don't enter the entire position. Those stocks are extremely volatile and of course can have the move of 10-15% per day, as you can see here, for example, on the 8th of March 2024. But when we're gonna be looking at the potential for a squeeze, I prefer those comparing to anything else. As you have seen in the beginning of this video, I am not expecting to retire with one trade. I made more than 30,000 yesterday trading AMC. I took the entire profit and I moved to the next trade, and I'm showing you what my next trades can be. Why? Because of the power of compounding. I don't want to stay into this trade for months expecting the roaring KT army to bring those to 3 digits. No, I simply make a profit and move on. And what helps in those strategy is of course the power of compounding and the ability to save on taxes on every trade you do. This is why my recommendation for today is to be mindful about your IRA or Roth IRA account. And especially if you're trading from the United States, it makes absolute sense to have an account where you can make all the scalps and all the short-term trades. I'm not expecting to advise you to hold the meme stock for a year or more. Of course, it should be a short trade. We're talking here about hours, maximum days. And when you take the profit and you are not paying that short-term capital gain tax on those profit, that would actually boost your portfolio towards your retirement by hundreds and hundreds of percent. So the partner of today's video is iTrust Capital, is the #1 crypto IRA platform in the United States, but it also allows you to trade many more commodities and stocks on top of the crypto, including gold and silver 24/7. It has one of the lowest costs, it has no monthly fees, and on top of that, if you are the DataDash viewer, you would get a bonus on subscription if you follow the link down below in the comment. Guys, I want to cover so much more, but I would love to have it in our second video on Friday, where we're gonna go in more details through stocks and the Bitcoin and altcoin charts. We're gonna chart 2 altcoins as I promised. With all that said, stay safe and see you soon.